Hey, everyone.
How you doing?
We have a good weekend.
Yeah, it was good. How was yours?
So we were finishing up chapter 6, is that right?
Yes.
Sorry. Um, been in country long distance. So on Friday, we finished up this chapter. We started some of the problems from this chapter, right? We talked about these three theories. The theories to explain these three facts about term structure, right? Different interest rates at different maturities move together. Short-term rates are low. The yield curve is likely slope upward, and the yield curve almost always slopes upward. And we said that there were three things that explain this: the expectations theory, which didn't quite do it; the segmented markets theory, which didn't quite do it; and the liquidity premium theory, which did it. Yeah. So the expectations theory talks about the averages of returns on bonds, right? If you would expect a 1-year bond, a 2-year bond to pay you the same in 1 year as a 1-year bond, yeah, and that we don't care really what maturity the bonds are. Yeah, where bonds of different maturities are perfect substitutes. So, and then we did an example, right? So the current rate is 6%. Next year, you expect it to be 8%. A 2-year bond should pay you 7%. And then this is the math associated with doing that. We went through this. No big deal, right? So, but it does not explain why the yield curve usually slopes upward. Then we had a second theory, segmented markets. That means that we prefer bonds of certain maturities. Me as an investor, maybe I want to put my kid through college, so I prefer a 20-year bond, something like that. This is the idea is that these bonds are not perfect substitutes, but partial substitutes. And then we said the liquidity premium theory, this is a combination really of the first two. And we have the interest rates over time, plus we have a liquidity premium, yeah? So there's a liquidity premium associated with the length of time of a bond. So then we also say that people prefer, this is a combination of the first two, yeah? We preferred bonds of one maturity over another. This is the liquidity premium. As you go out in time, it becomes greater and greater, and this is added to the value of the bond, right? So it's a premium associated with the length of time of the bond. And then we saw this picture of 4 different types of yield curve, steeply upward sloping, mildly upward sloping, the flat yield curve, and downward sloping. Let me look in the textbook about this one. So steeply rising yield curve in panel A, short-term rates are expected to rise in the future. So you see, this is steeply rising because the yield curve, the liquidity premium is built in. Without an expectation that yields are going to rise, this would slope like this, yeah? So short-term interest rates are not expected to rise or fall in the future in panel B. But you can see it's upwardly sloping because of the liquidity premium, right? So, and then C indicates short-term rates are expected to fall. But you see the curve is flat because the liquidity premium would have this downward sloping like this. Yeah? So the liquidity, we're expecting short-term rates to decline, but the liquidity premium is making the curve flat. All right? And then D indicates short-term rates are expected to fall sharply. So even greater than the liquidity premium. Yeah? As pictures of yield curves over the years. Are we cool? We did a couple of the problems and I put them up on Moodle. We're going to go to them now, but does anybody have any questions? Does anybody have any humorous anecdotes of college life? Okay. So I put up on Moodle today, I had a problem here. Every time I clicked on this, it wouldn't let me do. See, it won't let me do anything. Okay. So you've got class, all the classes are up on Moodle, all the Zoom sessions that we had, the PowerPoint slides and the problems. And this, I want to hide. We did 1, 2, and 3 the other day. Let's talk about 7. You guys ever heard of TIPS? Treasury offers some debt as Treasury Inflation Index Securities, or TIPS, an acronym for Treasury Inflation Protected Securities. Price of bonds is adjusted for inflation over the life of the debt instrument. What can you conclude about the liquidity premium of TIPS? What does anybody think about the liquidity premium on a TIPS? So the idea here is that this market is smaller than the regular market. Treasury inflation protected securities is a smaller market than the general bond market. So even though there's a higher yield, because it's inflation protected, we consider that a liquidity premium because it's traded less, it's traded thinner. So the liquidity premium is higher. Yeah? Does that make sense? When you move out the yield curve, that liquidity premium is bigger and bigger because those bonds are traded less. The TIPS is a smaller market, it's traded less. So the liquidity premium would be slightly more. Yeah? All right. If the income tax exemption on municipals was abolished, what would happen to the interest rate on those bonds?
The interest rates should increase since you'd have to start paying tax on them.
Yeah, that would raise the interest rate, yeah? Duh, for treasuries, it would raise the interest rate. Sorry. Sorry, I'm mixed up. What would happen to the demand for municipals?
The demand would decrease.
The demand for municipals would decrease, and therefore the interest rates would rise. on the municipals. Right? What about the treasuries? The demand for the treasuries would increase and the interest rate on the treasuries would go down. Right? Does that make sense? If we looked at supply and demand, okay, you've all got Moodle. I want to break you into groups and you guys do 22, 23, and 24. In your little group, draw pictures. One representative from your group could email me the pictures. And then we'll come back together in, I don't know, 10 minutes or so, and we'll have a look at these things. Okay?
How's it going?
Okay. For a Monday.
Yeah. A little slow.
You guys are working together on number 22, 23, and 24.
Yeah. Yep.
We're making progress.
I'm getting there.
Good.
What's going on, Professor?
Not enough. Hey, Shane.
What's going on, Professor?
You out for a walk?
What's that? No, I just had to get something from my parents' office real quick. I got stuck in between something.
So you guys are doing 21, 22, and 23? Yeah, sorry. 22, 23, and 24?
Yeah.
How's it going?
We just did 22.
Okay, good. So you're styling.
Silent. Oh, yeah.
Hi, gang.
Wait,
Are you making any progress?
Yeah.
Yeah,
mhm. Just
you're working together?
trying to get the graphs down for 22. In a nice.
Okay, good, man. Any questions?
Yeah.
How's everybody doing?
We're still trying to figure out 22. I think that I don't know how exactly to plot it or graph it, but I know that Greece would have a higher risk premium. So would that mean that the interest rate would be higher compared to the US?
Yeah, it sure does. So you want to draw a supply and demand curve for each country.
Okay.
And then you want to show the shift in the curves for each. Right?
Mhm.
Okay. Everybody's good?
Yep. Thank you.
It's just not going to the right one. Hold on.
What were you trying to do?
I was trying to share my screen to show him the explanation for 23, but I can't. It's not working.
I can allow it.
Do we have to show you like graphs, or can we just give you like a written explanation?
I prefer pictures.
Okay. So
You should be able to share, Caitlin.
I'm trying to. It was just not like it always pop up as the wrong one. So then I just kind of stopped trying because I would like click on what it said, the icon, and then just pop up as a different like window because I have like a bunch of windows open, but I kind of need them so I can't like close out of them.
Well, welcome to my world, man.
It just won't pop up the right window even though it says it will.
Okay. So we talked about 22, 23, and 24. Anybody want to talk about 22? What are we going to see happen? Did anybody email me?
Yeah, I did.
Did you?
Yeah.
With
Had, but we didn't finish.
You didn't finish? You know, you just click on the wrong thing and then you're like lost. Okay. These are great. Yeah, these are great. I want to draw, I want to see, let me just try this. Okay, what I wanted to do isn't working. I'm sorry. We will try something else.
What were you trying to do?
I was trying to get the textbook up. I want you to look at figure 2 in chapter 6 of the textbook. So we had two graphs here with supply and demand. This are bonds, right? This is quantity. This is price. This is Greece. This is America. Because of the economic climate in Greece, the demand for those bonds will go down. Reducing the price, increasing the interest rate. Yeah. And here, because these people won't have anywhere to invest, the demand in the US will increase, increasing the price and decreasing the interest rate. So the spread, that's between this and this, grows. The spread between the two grows. That's the whole essence of 22. Okay? So 23 and 24. God help me. Can't. This is 23. The expectation theory is the correct theory. Calculate interest rates on term structure for 1 to 5 years and plot the yield curve. A and B, 5, 7, 7, 7, 7, right? So year 1 is 5.
I
Year
hope so.
2 is 5.5.
I hope so, but he doesn't use.
Year 3 is 6.33. Year 4 is going to be 6.5, and year 5 is 6.6. Part B, same thing. 5%, 5 plus 4 for the second year divided by 2, 4.5%. 5 plus 4 divided by 3, 4.33. 5 plus 4 plus 4 plus 4, 4.25. So, and then it says, how would the curve change if people preferred short term to longer term? If people preferred short term, the graph would be even steeper here. Because of a liquidity premium out here. In other words, does that make sense? There's an increase in liquidity premium as the demand for those bonds goes down. There's less liquidity. Yeah? That's what we're talking about here.